Welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host, along with my weekly guest, Arusha Pires, O'Neill Global Advisors Portfolio Manager. And our special guest this week is Joe Fahmy, Managing Director at Zor Capital. So, Joe, we were talking a little bit about macro, and it was so easy for a lot of people to focus on the macro, just kind of looking for glimmers of hope when the market was not giving you much to be hopeful about. So, that being said, while it's not necessary to go so deep on the macro, there is that mantra of don't fight the Fed. So how do you kind of not get too deep into the weeds, but still make sure that you're following what's going on with the Fed and whether they're tightening and restrictive?
Yeah, I think it's important, as you said, you don't have to be a macro expert, but you do need to know the general direction or the cycle of what's going on with the Fed. There's a reason Marty Zweig came up with that expression, don't fight the Fed. And the lesson for me last year is we've heard that over and over, don't fight the Fed, don't fight the Fed. And in 25 years of doing this, it really didn't resonate until the past 5 years or so with me. And I can't think of a better example than after the pandemic. We made those lows March, April of 2020. And the Fed provided one simple word, accommodative, a very accommodative environment where they did bond buying. They purchased more treasuries in the 6 weeks following the pandemic than they did in the 9 years combined from 2009 to 2018.
Incredible.
So that provides tons of liquidity. Bond buying, keeping interest rates near zero, expanding their balance sheet. So when you say don't fight the Fed, what that means to me is when it's an accommodative environment and they're providing liquidity, don't fight that, ride the trend, and of course manage risk, but that means lean more towards the bullish side. Now, fast forward to the end of December 2021, early January of last year, those three things one at a time were taken away from the markets, where they announced they were going to stop their bond buying, they were going to start raising rates in 2022, and then reduce their balance sheet. So that one word of accommodative switches over to restrictive, where that restrictive environment is, in my view, you can't really assign a percentage to it, but I think is over 90% of the reason we had that bear market in 2022 is because of that restrictive environment. So again, you just need to pay attention to, are they raising rates or are they cutting rates and other accommodative or restrictive measures?
Mm-hmm. Yeah, and you're paying attention, you're aware of it, but then kind of getting back to the topic that we were talking about at the end of last segment, you're still letting the price and volume action be the final decision maker for you, and telling you when to get in and slowly pulling in the market when the market's acting right, or continue to push you out of the market when the market is selling off at key resistance.
Yeah, the market's a discounting mechanism, so they could be providing an accommodative environment, but you're starting to see distribution days, so price is gonna override all of that. And fast forward to today, you're starting to see better price action and some of that tighter price action that we're going to talk about. It could be the market anticipating, even though they're raising rates, anticipating the end of the cycle. So to your point, you need to know the bigger macro picture, but at the end of the day, the price and volume overrides and rules everything, in my view.
Mm-hmm. So before we kind of get into the idea of how much tighter things are getting, and by tighter, I'm not just talking about the Fed here, I'm talking about tightness in charts. But for a lot of 2022, I think it was marked by the opposite. There was a lot of extra volatility, and I mean, especially with Fed announcements, CPI data coming out. I mean, you look at the October 13th low that we had, and there was this just huge spread from the low to the high. And I mean, granted, it came back, which is great, but man, it really plummeted first. And so there was I think a big sense of, you never knew what direction was going to end the day based on where it started. There was just so much internal volatility. So what does that do for your investments, your style, and everything, cutting losses when you've got such high volatility on specific days?
Well, two things. Taking a step back and looking at key moving averages, just like you don't have to be a macro expert, you don't have to be a technical expert, but you can just look if we're below the 50-day, below the 200-day on the S&P, on the NASDAQ, what that's going to mean is a little bit of a red light to get defensive. So I would expect higher volatility just historically when we're below that 50 and below the 200. We were below the 200 most of the year on the S&P and rally to certain levels of resistance. So the first point is look at where we are relative to those moving averages and understand we're going to have higher volatility when we're below them. The second point is how you deal with it, as you asked, is either you just have higher cash or lighter positions to keep you from getting chopped up and constantly getting stopped out of things. So I know O'Neill has a rule, let's say 7% as a stop cutting loss. You could raise that you could double it to 14 or 15% if you have half the position. So instead of 100 shares at 7%, you could have 50 shares at 14%. It's the same math, but in a higher volatility environment, it gives you a little bit of room with your positions.
And when you say it's the same math, it's basically you're taking the same hit to your portfolio. In that case, you're kind of getting
usually a lot of hits in
the
bear market. Yeah, so it's just the losses are slower, just more consistent throughout the bear market. But yeah, it's still the same hit. Correct. Yeah.
So let's talk a little bit about this tightness that you've been starting to see in charts. So on the S&P 500, you started to see a little bit of tightness of where prices were starting to close around the same range over a few weeks.
Yeah, and my feeling is that as the market's anticipating the end of this cycle and institutions are putting more money to work, tight price action is important, especially on the weekly charts, because two things. One, it could be a sign of the selling drying up beneath the surface, and two, it could be a sign of the institutions accumulating sort of at a magnet at a certain price. So with the S&P at the end of December, there were 3 weeks where we closed roughly around 38.40 for 3 consecutive weeks. So that showed some of the selling drying up, as well as, to your point earlier, when we came down from that 200-day, we started to see support around that range in that low 38.50 range. So that was, by doing that simple analysis on the weekly charts, that was a sign that there was potential accumulation and to sort of wake up a little bit to the possibility of a new uptrend coming.
Yeah. So can you kind of talk a little bit about that? Maybe tell a story about how that's accumulation. You kind of said it's kind of like a level where they're comfortable buying, but should you be seeing heavy volume there too? I guess this was one of the tricks because we also had the holidays around the same time. So you got lower volume because of the holidays. So it was almost like, oh, does this price action even matter? There's not much volume. People are gone. So can you just kind of fill in the details there?
Yeah, we did have successively lighter volume because of the holiday shortened week. So I definitely was not skeptical, but I was just keeping that in the back of my mind, figuring when new money flows in beginning of the year, beginning of the month, that we'd get a feel for volume, whether the volume was going to come into the upside or to the downside. But my feeling is, and you guys would know better because you've done the studies, my feeling is that when institutions want to accumulate, they sort of have a magnet with a certain price that they're willing to buy it up to, whether it's with the index or whether it's with an individual stock. So from studying history, I have found that tight price action is to be interpreted as the institutions accumulating beneath the surface.
Mm-hmm. Yeah, when you talk about this tightness, and especially in a bear market, the first kind of story that comes to my head is back in 2008 when all these stocks were selling off, and Apple at that point, and I'll switch it over to Apple here, and I'll go back to 2008. But it kind of was really interesting to learn about this, especially after I started to work at the firm. But one of the kind of the key things that Bill O'Neill was looking at in Apple during that time when the markets were selling off in the fall of 2008, he started to notice that there was tightness within Apple over 4 weeks, where it all kind of magically closed around the same price range. So really closed around like 96, 97 for 4 straight weeks. And so that was kind of the first thing that he noted, that, hey, there's some institutional accumulation here. Didn't necessarily mean that he went and bought it at that point, but he was just kind of, it was just kind of like a check mark that some institutions are coming in here, starting to support Apple. Now let's see if it starts to build some kind of trading range that we can then eventually merge out of, that we can start buying Apple again.
Yeah, and that's a great point. The tightness doesn't necessarily have to be only on the right side of the base or only as they're accumulating and coming back up. There could be signs on the left side and throughout the entire base. So sometimes in your example, which is a great example with Apple, even though it's several weeks, much, whatever, 10, 15, 20 weeks, within that, there was a lot of almost like a magnet. It kept coming back to that price, even on the left side. So that's a tip. It's a tip that the institutions, or could be a clue that the institutions are accumulating, even if it's earlier on in the base.
And I like the term clue, because I feel like in a lot of these cases, you're almost collecting clues. So in the case of Apple, you had that tight action again on the left side. So it was almost like it didn't want to go down anymore. There was such pressure from the market, and you can see on the index chart above. And by the way, this is available on video at investors.com/podcast for those of you that are listening, if you kind of want to just go back and look at this part on video, but we'll try and describe it. The indexes were making new lows after that, and Apple just seemed like it was resisting that. It just seemed like it was trying not to come down as much, and eventually when the S&P 500 made its ultimate low, Apple was holding up. And so, it started kind of with the clue of tightness, and then followed up with more clues. And then before too long, you've got, I guess maybe the balance shifting, in a way.
My theory is these big institutions have the resources that most retail people don't have, meaning they've done the fundamental work. And let's not forget what happened in 0809 is two of the greatest, arguably the greatest products of our lifetime were just starting to roll out with the iPhone and the iPad. So these institutions knew the total addressable market and the potential. So if they're accumulating beneath the surface, it's probably with the objective of a 3-5 year or longer time frame. So I like to say, okay, I don't have the resources to do as hardcore of fundamental work that they do, but they give clues of their accumulation during these corrections.
Just right in their wake.
Yeah, exactly.
So maybe we'd shift this back to kind of, are there current examples of stocks that you're kind of seeing this action in? So we talked about Apple as a historical, S&P 500, the weekly tightness that you were seeing kind of around the holidays. What about individual stocks? Anything catch your eye there?
Yeah, there was a couple. United Rentals, URI is a symbol. That's one recently where as it built the right side of the base, it just had several, and it doesn't have to be 3 weeks tight, 4 weeks tight. It could be 5 out of 6, 5 out of 7. In this case, as it ran up, it let 10-week catch up to it. Sometimes on the right side of a base, when a stock runs up, it just needs to correct through price or through time. And it corrected beautifully and just held those gains to the point we made earlier. After a nice gain, sometimes they just get sold into strength. This had very, very nice gains along the way. Ironically, they reported today after the close and beat estimates and raised guidance. And I think that, again, to our point of the institutions have done their hardcore fundamental work and they're accumulating it. It's not automatic. You, of course, have to manage risk and have a loss-cutting policy. But my theory, again, is that they know the fundamental story and they're accumulating it. And as long as it's has that tight price action holding the 10-week, it's acting well in my view.
Yeah, and also because it was having the tight price action going sideways while the market was still struggling, you're starting to see more relative strength coming into United Rentals. So you can see that RS line starting to make higher highs, and actually it was getting the blue dot before it even started to emerge out of this really large consolidation or potentially emerge out of it.
Yeah, so when things were volatile in the fourth quarter, it shows relative to the market that strength by holding up so well, almost like it's waiting around. Bases are being formed during corrections. It's just waiting around. Okay, Mr. Market, when you're done correcting, I'm ready to go higher. So that's the encouraging thing is learn to interpret bases and study bases, because bases for the most part are formed during market corrections or pullbacks.
Yeah,
Yeah.
and also to go off your, what we were talking about earlier, that institutions have to be invested, mostly invested all the time. They might be selling some other stock. Let's get out of that stock and let's just park more money into a United Rentals, right? So it might not necessarily even be it's the best out of the best out of a batch that they can buy in a really tough market. So like, let's just keep parking money, and it's not just one fund; it's many funds saying that. It's like, what, this is a good place to just keep slowly building a position into United Rentals, and when the market slowly gets better, this one should do well, and then maybe you can eventually lighten up and get it into more growthier type of stocks when they're really ready to go.
Yeah, as they're rotating maybe out of a weaker position or something that they sell, they might add to a winner or something with better prospects. Absolutely.
Mm-hmm. So let's take a look at another example, and this is MedPace, ticker symbol MEDP, and I need to disclose that I do have a position in this myself.
As do I.
So maybe you could start with this. This kind of had, and this is one of the things that on MarketSmith, for those that are looking at the video, you will see this kind of little blue shading when there's tight weeks. It's just a very subtle blue shading, and MedPace had two. Now, first of all, it had this huge move on its earnings report. I mean, it was like up 40%, but more importantly, it kind of held that. And I guess what I want to kind of have you talk a little bit about is it felt like there was a lot of stocks that were showing 3 weeks tight before, but then they'd go lower, they'd get knocked down. It seems like there's more 3 weeks tights forming now where you see an upward move, or at least you have for a week or two. Is that what you're seeing too?
Yeah, the tightness is in the example that Arusha gave with Apple. It was on the left side of the base while we were still correcting. If we're slowly starting to come out of this, now you're right. You're seeing tightness, and then it's stair-stepping higher with even more tightness. So the tightness overall is not just on the left side of the base, not just as you're building the bottom of the base or the right side, is as a subtle character change. As things hopefully start to break out, you start to see it hold in that level. Another sign of health that strength isn't being sold into. It's actually being accumulated after the breakout. So it's a great point that you're starting to see some tightness as we're moving higher as well.
Mm-hmm. And this is another one. Arusha mentioned the blue dot, which is the relative strength line getting to new highs. I mean, it jumped to those new highs on the earnings report. But again, this was one of those cases where the tightness, and I think you mentioned this earlier before, Joe, that sometimes it's kind of nice because it lets the moving average lines kind of catch up a little bit and take that breather.
Yeah, so it ran up huge off of those earnings, unexpected, better than expected. So that's another reminder during corrections. Let's not forget, we tend to have a lot of recency bias that everything is horrible. Let's not forget there are newer entrepreneurial companies that are flourishing in a corrective environment. And as soon as the correction is done, those could be the ones that move to new highs. So they had better than expected earnings. It pulled back, but during the pullback, while the market was volatile, there was a lot of tightness in the bottom of the base. It stair-stepped higher, a little bit above that 10-week. So that's double supportive action where it's being accumulated and holding that 10-week. And then it's just slowly stair-stepping higher. So again, there's no certainties in the markets. I always like to talk in terms of probabilities where when you see that, it just increases your probabilities of something working out when you see the institutions accumulating it combined with the earnings and sales growth.
Yeah, no, I'm kind of glad you mentioned that. There are no certainties, because you could have the best stock in the market in the best industry group and the greatest bull market ever, and it still could fail. And so that's why we always do have that sell rule, just to get us out. Because for whatever reason, these stocks can go down, and risk management is the top priority.
Right, but if you're buying it, that's a great point. If you're buying it around that tightness and around a flat area where you see a defined range, your risk management can be if it breaks below that range, rather than buying it when it's straight up in the air and not buying it properly. So those bases, even though they might not work, gives you a range to at least set a stop around that range.
Yeah, and I mean, having those risk management rules in place and kind of a signal that, hey, this is breaking my expectation, because if it were doing the right thing, it would hold here. And if it's not, then you have a clear signal that you can just get out. Now, just to kind of wrap up this section, we're seeing more tightness. We're seeing a lot of stocks kind of come up to previous resistance levels. We're seeing that in the indexes. We're seeing that in individual stocks. I guess the fear is that they come up to those resistance levels and get turned away again. So what are you looking for going forward in terms of giving you more confidence that, hey, this time it's for real, it's not just one of those bear market rally fake outs?
Yeah, I think one difference is between now, I'm subtly noticing more stocks working out. So beneath the surface, we want to see more stocks breaking out on good volume, holding their breakouts, and the broader the sectors, the better. Mm-hmm. So let's not forget, we tend to live in a very impatient world where everyone's expecting, hey, are we going to new highs tomorrow, or are we going to break down? I would just like to see slow and steady progress, meaning breaking above those key moving averages on the indices, with individual stocks breaking out, holding those levels, and sideways digestion would be healthy. And then hopefully a whole crop of stocks start to set up. But it's slow and steady. It takes a little bit of time. Let's not forget, even off of the March of 09 lows, some of the true leaders like Baidu and Apple and even Chipotle later on, they didn't come until a few months afterwards. So in other words, if the rally's for real, there'll be plenty of time and more stocks showing up.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.